don't believe that partial sale of state assets is a good idea.
Yeah.
The best to stick with that plan.
Look, I set some tests in that speech earlier in the year, and those tests are about prioritising New Zealand mums and dads and making sure that 51% control is held by the state. My view is that I want to see that research that comes back from Treasury, but I think it's the right economic measure for New Zealand at a time where we're looking to acquire more assets, where we're looking to build the savings pool and capital markets of New Zealand, and where I think we can get better management of those companies. Now, I accept that we need to do and continue to work hard to explain to New Zealanders why it is we think this is a good policy, but I think it's in New Zealand's best interest when we're staring down the barrel of a significant debt issue where we risk a downgrading from New Zealand and from rating agencies, and where we've got a lot of assets that we want to acquire to carry on with this policy. And that would be my preference. In the end, as I said to New Zealanders, there'll be no change in this policy until there's been a general election. They'll be the final arbiters of whether it's the right policy call or not.
You've already acknowledged that it's quite difficult past that initial sale to actually keep it in local hands or among investors. Doesn't that, mean that one of those tests is pretty shaky anyway from the get-go about, targeting or prioritising mum and dad investors? It's actually quite.
Well, the first thing I think that's really important is that we can't expect every New Zealander to understand the history of asset sales in New Zealand, but the historical position was assets sold pretty much 100% of the asset and often sold in a trade sale to another international buyer. We are proposing a very different model, one where 51% control is held by the state, so by definition maximum control is held by the government. Secondly, the structure of the New Zealand capital markets and savings pool now is very different. There are 1.6 million KiwiSaver accounts. There are billions of dollars that need to be invested by New Zealand Super. There are New Zealand mums and dads that are looking for alternative investments to finance companies. So my view is that you will see the overwhelming bulk of these assets held in New Zealand's hands.
Treasury says that it could end up, Treasury says there's a likelihood, and history shows tends to end up in foreign investment hands.
That report wasn't in relation to the mixed ownership model. That report was in relation to if there was open slather sale of state assets, and that's not what we're proposing.
So that's totally relevant to the model that you were suggesting?
Correct. We're talking about a mixed ownership model where 51% control is held by the state.
So you don't accept that there is a likelihood or a likelihood that it could end up in foreign ownership, even with a mixed ownership or partial asset sale?
No, what I accept is that we're going down the right path of making sure that there's 51% control, because they were commenting on open access where all the company would be sold, and that would introduce a completely different set of issues. But with 51% control held by the state, you significantly reduce that issue.
On the debt issue, I can see it affecting the government debt in terms of countries' debt, which is largely in household and companies. It's not really going to shift that at all, is it?
Well, it may do over time. There's a lot of different factors that matter here. So for a start off, if we take pressure off our borrowing requirement by releasing capital, that at least means we're not crowding out the international markets, and the rating agencies look at the total stock of debt that's required. The second thing here is that if we use some of that capital to invest in other parts of the economy, higher growth assets, then that can actually help grow the economy and therefore grow the savings pool. Thirdly, these companies, while they're mature businesses, they're actually companies ripe for investment into them, and I think you can look at companies like Solid Energy and Meridian that has technology it can deploy internationally. Mighty River is another example. So if they're constantly going to be required to come to a cash-strapped government, I don't think they'll grow. So I think if you look at the overall pool of investment and the opportunities to lift national savings, look, they will help. No one's arguing this is the one thing that will transform, but we want to acquire $33 billion worth of assets over the next 5 years, and we don't want to constantly be borrowing money on the international markets.
What if they have to borrow in order to grow?
Well, they might do that, but again, they'll probably have a sounder management structure in terms of their overall governance to make those decisions. Certainly that's been experienced with Air New Zealand.